Welcome to Swayam online portal. The MOOC course is on Public Financial Administration, and in today's video we will be studying on evolution of public financial administration. It's very interesting to see that the evolution has seen India as an emerging economic power. If you go back to the history, we start with the history of the Arthashastra, which reflects Chanakya's evolution of finance. And his financial administration is remarkable as far as the history of financial administration in India is concerned. Going through the history and historical events, we can categorize the evolution of public financial administration in three parts before we go into the depths of evolution of financial administration. The first point is pre-independence phase, which is before 1947. We'll also study a little on the post-independence phase between 1947 and 1991. And of course, the third is the liberalization era, which brought a remarkable change as far as financial administration in India is concerned. It started from the year 1991 and beyond, and after which it was no looking back for India. Looking into the pre-independence phase, which is before 1947, one must wonder what is the status of banking in India. You will be surprised to see that during this phase there was a large number of banks present in India, which was say around 600. And the establishment of Bank of Hindustan in the year 1770 in Calcutta marks the starting of the Indian financial system. The banks, of course, discontinued its services in 1832. And then we have the pre-independence phase, that is before 1947, when the British was ruling our country. There were various banks that evolved post to the Hindustan banks, such as the General Bank of India from 1786 to 1791 and the Oud Commercial Bank from 1881 to 1958. However, these banks were not able to continue for long because of the financial misappropriation. And then we have the pre-independence phase before 1947, which also reflects that in the 19th century, we have some banks like the Punjab National Bank and the Allahabad Bank, which was formed in 1894 and 1865 respectively, is still existing. Three major banks at that time, like the Bank of Bengal, Bank of Madras and Bank of Bombay, were emerged as one body, which was termed as the Imperial Bank of India. And now this Imperial Bank of India is famously termed as the State Bank of India. As we go through the pre-independence phase before 1947, the Bombay Stock Exchange was established in 1875. It's Asia's first stock exchange. The BSE, which is famously called, has helped develop India's capital markets, including the retail debt market, and has helped to grow the Indian corporate sector, which we are still indebted to. Hilton Young Commission in the year 1935 recommended the establishment of the Reserve Bank of India. This was the phase in which majority of small-sized banks failed to function properly and were unable to gain people's confidence. People were more involved with money lenders and unregulated players. And so, as far as the finance is concerned, it was not very hopeful as far as the economy of India is concerned. Post-independence, of course, saw the slow development of economy, and we won its pace slowly but steadily. The government, in order to overcome this situation, decided to nationalize the banks under the Banking Regulation Act of 1949, which was very effective and efficient. The RBI was nationalized in 1949 and later on in 14 commercial banks were nationalized in July 1969 during the tenure of Indira Gandhi. During the post-independence phase, that is between 1947 and 1991, it was characterized by the nationalized bank, which actually also saw the depths of rural development. It was not only urban development but also rural development. It also attempted to help the grassroots level people to develop and grow in terms of economy. Majority of the banks in India were privately owned at that time of independence and were serving only big corporates. Rural population was suffering, small-scale industries and agriculture sector were still dependent on local money lenders. And that's why we see that the farming industry was facing a lot of issues. As far as agriculture was concerned, it was not developing. So it was realized because of the Green Revolution and the dairy production and also the dairy revolution that why not have agriculture banking, and that actually paved way to a lot of more development as far as rural and banking is concerned. The Narasimhan Committee in 1975 recommended the establishment of RRBS, which is Regional Rural Banks for Development of Rural Sector and providing services to unserved ones. There were several other specialized banks which were constituted during this period to serve and support the development of economy. One must remember that after independence we were thinking about welfare state, and so grassroots level development was inevitable and very important. There were like the NABARD in 1982 for supporting agriculture related activities, National Housing Bank in 1988 for the housing sector, and SIDBI in 1990 for assisting small scale firms. So you see that we have the support of agriculture and also housing sector and also small industries and entrepreneurship. Nevertheless, it was not very effective as it is right now, as we saw the housing sector having a very high interest rate, and also NABARD saw the debts of the farmers could not be met easily, so reforms were introduced. Nationalization was a remarkable step in the banking industry which boosts the country's growth. It was successful in gaining people's confidence in banking services, and also smaller groups were easily able to access capital from financial institutions post-nationalization. The liberalization era was a remarkable phase as far as the Indian economy was concerned. Why do you say that? It's because it was stabilizing force under the chairmanship of Sri M. Narasimhan for bringing various reforms. During this period, government opened up the economy and granted private players entry to banking industry. RBI granted license to 10 private sector banks, out of which only few notable survived, like the Axis Bank, HDFC Bank, DCB, ICICI and IndusInd Bank. In 1992, National Stock Exchange established to provide fully automated electronic trading. Now you see a lot of digitalization as far as the banking industry is concerned. It has transformed the total outlook of the banking industry. The Narasimhan Committee again in 1998 recommended the entry more private entities in banking industry. And if you see, the Kotak Mahindra in 2001 and Yes Bank in 2004 by RBI was an eye-opener. Further, in 2013-14, a license was granted to the Bandhan and IDFC Bank, which brought in remarkable loan grants and also methods and ways to reduce the loans. There were several measures also that was taken during this phase where there is entry of foreign banks in India. Equal treatment was given to both public and private sector, and you see that the way the private and the public sector were working in tandem, shoulder to shoulder. The RBI also was altering plans so that the nationalized banks have remarkable changes. The introduction of payments banks, setting up of small finance banks, and disallowing any further nationalization of banks was one of the commitments of the RBI. Now let's go into the history of the public financial administration, because we see that India is now emerging as one of the strongest economy. Despite being slow, we are giving a lot of challenges to many of the countries around the world. Because of its open policies and FDI plans, it has become one of the renowned and powering financial system as far as finance is concerned. When you look at the history of Indian financial administration, we can talk about the Sher Shah Suri and Akbar's administrative policies. It has been highly centralized. The financial administration in pre-British India has also seen a steady growth of economy. We can also talk about the Gupta and the Mughal periods were important in financial administration, and you can see how it is evident in Chanakya's Arthashastra. Principles of public finance was imbibed with ethical consideration, and that is quite remarkable. Because if you see Arthashastra, which pines on finance and administration, you see how the ethical consideration is very important and moral values were imbibed in the system of finance. Classification of revenue and expenditure was clearly demarcated. Revenues were classified as tax and non-tax. Land tax was the mainstay of tax revenue. Taxes were imposed on merchandise, gold, cattle, etc. As far as Chanakya's good tax system is concerned, it talks about fixed certain ranges of various taxes, like land tax 1/10 to 1/6 of the produce, depending on how good the produce was. Merchandise tax 1/12 of the commodity. The non-tax revenue was income from public works, and it was remarkable to see that revenue and expenditure was clearly demarcated and effectively and efficiently managed. And Chanakya's public expenditure, it was on defense, administration, police, public works, public welfare, public borrowings was known. It was quite popular during the pre-British India. Expenditure also was made based on the revenues or the income which was obtained, and surplus was given to the public treasury, which was saved and used during the time of emergency. So if you see, Chanakya's system of economy was quite systematic and process oriented, and you see the demarcation between revenue and expenditure. You also see how the land revenue was collected based on the produce, and the ethical consideration is one of the highlights of Chanakya's Indian economic prospects. We can also look at Muhammad bin Tughlaq's administration as far as finance is concerned. It was quite erratic. It was quite opposite of what was Chanakya's Arthashastra speaking on. It resorted to deficit financing and currency manipulation in Indian history and history of finance is concerned. The system of financial administration involved collection, custody, and disbursement. The Collector General in charge of collection. There was a Treasurer General for custody of funds and was responsible for balancing revenue and expenditure. The chief superintendents of various departments maintained accounts. There was no civil service or bureaucrats running or managing the accounts, no accountability and no responsibility. It was highly autocratic people were misusing and using the funds as concerned and according to the whims and fancies of the autocratic rulers. The finance under Mughals, there was direct taxes, land revenue, income tax, capitation, jizya, as it was so called. It was given to the Hindus. Todar Mal was the finance manager, produced a manual for collection and assessment of land revenue. The Mughals relied on non-governmental agencies for collection and transmission of funds. You can see some similarity about Mughals' finance and also Chanakya's Arthashastra, where the revenue and expenditure was recorded, land revenue was practiced to the best of the possibilities and availability of the produce, and also the Mughals determined their revenue and expenditure very conclusively based on what they got, income and their expenditure, and also they relied on non-governmental agencies so that they can get the revenue and income which could match the expenditure. Financial administration, as far as the Mughals and the Guptas and the Mauryas are concerned, was quite transformative, and it was also helping and benefiting the Indian economy and also the Indian administration and the Indian system. There was overall development and growth. But as the British had entered the Indian lands, complete change had happened because it was totally exploitative in nature. The East India Company came as a corporate sector, intervened and swindled as much as possible. The securing Diwani rights after the Battle of Buxar in 1765 was the first drawback, I would say, as far as the finance is concerned. The Board of Control of East India Company, which is a master of finance until Government of India Act of 1833, was collecting the finances in the form of taxes, commercial corporation into a governing corporation. And governing means administration, and also it was not just for business but also for administration. In fact, it is to take in more money from the Indians and support the war or the army of the English. Before 1833, the superintendent and control of public revenues rested with the governor's presidencies. Only during wartime it came under the Governor General. And so you know how the exploitation continued, because the governors had full control of the finance and they were quite confidential. And it was only during the time of emergency the Governor General intervened. The Finance Secretary coordinated with the Governor of Bengal and the Governor of India. The Accountant General of Bengal was later named as Accountant General of India. The Deputy Accountant General, although looked like a small post, was very pivotal in making changes in the economy of the East India Company, was a junior secretary to the Finance Department. The audit was taken care by provisional governments, and Lord Canning did one change, which was combine the accounts and the audit, which was not very advisable. The financial administration under the Crown. So now we see how the East India Company has swindled the money and it was realized by the Crown. So the Crown took complete power of the East India Company and vested few powers with the Governor General, so that there is no misuse of the funds. Because what happened is very soon they realized that as it was decentralized, the power of finance was not vested with the Governor General nor with the Crown. It was vested and decentralized, it was vested with the governors. So slowly the change brought in complete transformation again as far as the finance in India is concerned. Remember, during this period, exploitation of the people has been continuously happening. Irrespective of this, we were able to stabilize the economies. That is really a wonder. The Sepoy Mutiny of 1857 transformed the Indian scenario completely, because now the East India Company came under the Crown, and it came under the vigilance of the Crown. The Secretary of the State Council was the chief regulator of the financial system. The Governor General delegated financial authority to the Secretary. The Finance Department was the custodian of Indian finances. The Controller General combined responsibility for Indian audit and accounts. So you see how complete control of the finances was essential for the Crown, so that the economy was smooth and moving. There were three tiers which needs to be remembered as far as the finance administration under the Crown is concerned. One is the Secretary of State, which comes from the Crown itself, then the Governor General, and then the Governor. The Secretary of State controlled the whole system, the acceptance of Indian budget, regulation and control of expenditure, and the executive order. As far as the Finance Committee is concerned, the office of the Secretary of the State, especially the Indian office it was called, the Finance Committee was very challenging and also more committed now to see that it's very resourceful as far as England is concerned. The Finance Committee was assisted by the Finance Department of the Indian Council. Finance members of the Finance Department had two duties. One is administration in general, and then the other was administration of different provincial departments, so that they could be resourceful and they could get the right revenue and the expenditure can be met. So there are some critical comments as far as the administration of the Finance Department is concerned. Of course, the finance member was more a secretary of the Secretary of General of India, and the critic was that new expenditure could not be met. Challenges were plenty, as it was required to clarify many of the expenditure, and extravagance was so much it was questionable. Of course, apart from this, they had to take care of the military finance, and it is all seen in the Montfort reforms. If you see, as far as the finance is concerned, the Montfort reforms brought in complete change of the reforms in India. And what are the reforms India has brought in since the Montfort is, you can see how the banking system has changed, and you can see how the other forms of economy has opened up. And the changes in the Indian finance after independence has seen, although it is a repercussion of what we saw in British India, we saw a lot of changes. But the Minto-Morley reforms and the Montague-Chelmsford reforms was something which brought in change as far as the finance is concerned. We know that India is challenged with this economy. If you see that the farmers are dying because of debt, the farm bill is being reflective of the farmers' reforms. The grassroots level economy has not developed. As far as the small scale industries are concerned, it has been a big concern, because the microfinancing has to be reformed and changed according to the needs of the people. Now, currently, if you see, after the reforms or after the liberalization policy, India was facing a new phase, I would say, a facelift. And what is a facelift? It is the state versus market. The state role has minimized or shrunk to a smaller extent, and the role of the market has expanded. And if you see, there is more of movement or liquidity of funds. Now, you see more of privatization. There was a worry whether privatization will eat up our economy, but privatization will also bringing changes. We can see that there is quasi-social reforms. Now, what do you mean by that quasi-social reforms? social system should have social relevance. It should have a welfare intention. And the welfare intention is to bring in changes and also bring in remarkable changes as far as the liberalization policy is concerned. The Indian economy has been facing the challenges of the global pressure, and also the multinational companies which has come into India has also been facing a lot of challenges as far as the license is concerned. Currently, you see that India is following a business model, a capitalistic model. And why do you think that the capitalistic model is successful? Because most of the business tycoons would endorse that point, because Indian system is very wholesome, I would say. Because if you see, there are various sectors of people, and if people have to benefit, it is through entrepreneurship of small scale businesses and privatization. And if there is proper privatization, then they will think of profit and they will think of reforms. If you take England itself, because when you talk about new public management, England brought in this new public management in a business model, and it is famously called as the Thatcherism model or the Reaganism, because what happens is more of privatization happens. Now, if you see, Indian airports are being privatized because it can also give a facelift and also improve the economy of India. And also it necessarily, we need to have corporate sectors involving in every department, every sector in the agriculture industry, because it can influence by technology, it can influence with finance. You can see that small farmers are selling their lands and trying to bring in economy by selling their lands or closing their debts. But that is not good or favorable to a country like India. So private or corporate companies can support the farmers, they support the small industries, the cottage industries, and also it becomes a social responsibility as far as the corporate sectors are concerned. And also there is total community development. If you see, Tata is a very good example as far as corporate social responsibility is concerned. They have a township model which actually effectively practices a very good economy which stabilizes. And of course, India has a very good cooperative system. The cooperative banking sector is improving leaps and bounds. If you see, it has saved the tea industry, it has saved the rubber industry, it has saved the weavers. So I think if we have a systematic and a prospective and take lessons from the history of our Indian finance administration, we will not fail. We will progress slowly but steadily. The Indian economy is a grace, and also it has opened up its policies, it has become multilateral, and also it is becoming multidisciplinary, because every aspect of a department also involves the economy. And it has been realized that apart from what they have to do as far as administration is concerned, the finance also has to be looked into it very prospectively. And as we study this evolution of financial administration, I hope you will also inculcate the happy aspect of having a good economy as far as India is concerned. I hope you understood the evolution of financial administration. Thank you very much.